Rent the Runway is going public, looking for a valuation north of $1.3 billion on the back of a story that they can be consumers' closet in the cloud. In today's video, we are breaking down the losses that come with building that type of business, the bull and the bear case for the equity, and the absolute smack in the mouth that they took during COVID. Stay with us.
I'm Hannah, this is Erin, and you're watching the Piper Rundown. We analyze business and culture to help you win. We're on a mission here on the Piper Rundown. We want you and your brain to grow and expand. We want you to have a big business brain here. How can you do that? By hitting subscribe. Right, Erin?
Ring the bell.
Ring that bell. You know you want to.
You may want to ring the bell. You may want to wear luxurious designer brands without burning through the entirety of your savings in order to do so. If that is the case, then Rent the Runway is the flagship solution to your problem, a platform for renting designer clothing. Often for big events, you think about, man, this, crazy expensive. It's aimed more at women. Dress is, not something I'll ever wear again, but I want to have access to it for this specific occasion. Came to prominence in 2009 and is now going public. They are looking at raising around $290 million at a valuation north of $1.3 billion. That will put them in the range of $18 to $21 on the NASDAQ in the near future. The company is based out of New York, with co-founders Jennifer Hyman and Jennifer Fleiss. They have more than 750 designer brands on their platform that their customers can get access to. The access is usually gleaned through a subscription. They kind of started in a more one-off model, and they still have that as a small portion of their business, very small portion, but they claim that up to 80% of their revenue is attributable to subscriptions. Those subscriptions can range from $89 to $199 per month for your closet in the cloud. And if you want to infer what the inflection I'm putting on that, what my tone is, this is a classic example to me of a physical goods retailer, a physical goods company trying to sprinkle the well wishes and the perceptions of tech on something that is very much rooted in the real world. They are shipping expensive apparel to customers who are wearing it and then sending it back. They are responsible for the repairs. They are responsible for the timeliness of the delivery. They are responsible for managing a very complex and moving inventory, which you could argue is a part of their moat relative to other players that might want to compete in a similar space. And they have gotten there by raising more than $520 million from some blue chip investors, including Bain, Kleiner Perkins, and TCV. They have also been punched in the mouth. After achieving a unicorn valuation, they had to take a down round in the fall of 2002, dropping the valuation down to $750 million, meaning that all the previous investors, all the early stage employees saw their relative holdings significantly reduced. Anytime you have a down round there, it's a bad news for all the early folks. The reason is this is a very events-driven business. Events in the sense of going to work, events in the sense of going to a wedding or a gala or something where you would be wearing something fancy like this. And in a world of lockdowns, in a world of people staying in, wearing sweats, wearing comfy clothes a majority of the time, if anything, putting on like makeup and a top for a Zoom call, and then staying in their shorts for the remainder of their body. Guilty. And so that has led to not only a drop in revenue, but an extension of some really substantial losses for this company. $259 million worth of revenue in 2019, only $157 million in 2020, and in the first 6 months of 2021, they've done $80 million worth of revenue, putting them on pace to basically be flat year over year. Even more troubling, the losses. In the year, they did $259 million in 2019, $153 million worth of losses. Not great, but on a proportional basis, they are doing more revenue than they are losing, and you could at least start to tell a story of a downward trajectory. No such luck. $171 million worth of losses in 2020 and $84 million worth of losses already in the first 6 months of 2021. All of this while having more than $16 billion worth of assets go through their platform in total gross merchandise value. The subscription numbers look reflective of that drop. 147,000 subscribers in 2019, down to 95,000 in 2020, only up to 126,000 here in 2021. Part of the reason for that not being reflected in a climb in revenue is the fact that they have altered their subscription model in the face of COVID to not only reduce the price, reduce the leverage of it. So they used to have an unlimited subscription. Those ranges from $89 to $199 still have set number of rentals that you can possibly do on a monthly basis. And then the other side of it is they added a resale business. So we've previously covered a company called Poshmark that we'll actually get to in the comps section here that sells used apparel, and that's their entire platform purpose. Rent the Runway has moved into, okay, this has been worn a few times. Now we're going to sell it, as opposed to, I don't even know what they were doing. It kind of begs the question, what were they doing with it before? They basically wore it into the ground?
Pretty much, like use it, reuse it. And I can see how some of the pieces would get more of a shelf life if they weren't necessarily being used as much. But yeah, the resale business adds an interesting element to this.
13% of their revenue in 2020 was attributable to that.
Wow. Whenever I see a business like this that's like kind of easy access to high-end goods, it has the sex appeal, the immediate like attraction, but ultimately, like how sustainable is this? The numbers kind of speak for themselves.
I remember when it launched though and it started to get some traction, it was a very novel idea.
People love the service.
And there was a utility to, hey, I don't want to shell out for a fancy dress that I only wear one time, so I'm saving.
Sure. But even now, like I remember I have a wedding coming up at the end of the month and I went on Rent the Runway to see what options were on there, and like ultimately it didn't make sense to shell out for the subscription or like a one-off dress to rent for this one weekend.
Can you explain why? Can you actually like get into like that decision-making framework that you went through?
So there are other very viable options like Poshmark, which we have covered on the rundown before.
And then you'd own it.
You would own it and pay less possibly than what you could pay for given it is like a high fashion luxury good, but you could own like something similar that'll get the job done for less.
But one of the challenges with luxury is as soon as you're reselling it, it's like a car where the drop in value is precipitous versus like brand new out in the store.
Exactly, yeah. So it really just depends, does the brand name really, really matter to you? And you have enough events per month in which a subscription like this would make sense to like have something new and flashy to wear all the time.
A closet in the cloud.
A closet in the cloud. Well, let's move on to the comp section where we cover some of the comparable companies and competitors of the businesses that we are discussing. It's very helpful whenever you're looking to invest to get a feel for the surrounding business landscape. So Aaron, tell us about the comps.
So when you read the S1 for Rent the Runway, they just hit you subscription, 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 subscription. Sure. It's a consumer subscription. And if you remember a couple weeks ago, maybe it was over a month ago, we covered Duolingo, which had an exorbitantly high valuation. They're now at a $5.8 billion market cap because they had a consumer subscription that was digital, that was infinitely scalable, beautiful marginal costs, very attractive business in the same, maybe a cousin, but the same form as a Spotify or Netflix or some of literally the best businesses on the planet. Mm-hmm. That is what they are attempting. They're attempting, if Duolingo was like trying to point up at Spotify, Rent the Runway is a little bit lower and they're trying to point up at a company like Duolingo.
Yeah.
The difference is it is a physical business, not an infinitely scalable digital media business like Duolingo. Company. So that will be attempted. It's important that when they say it's a closet in the cloud, they're trying to elicit that type of model. That's the positioning that they're doing from a PR standpoint. In reality, their competition looks more like Stitch Fix, Poshmark, and ThreadUp. Stitch Fix is going to give you the convenience of sending a box directly to your house. It's always new, you're always owning it, and you don't have to keep everything in the box. You do have a degree of flexibility. They have a $3.6 billion market cap and unparalleled insights via the data that they are collecting on their users. Rent the Runway's CEO, Jennifer Hyman, also talked about similar insights into what people are keeping, what people are asking for, what people are looking for, being able to inform future decisions. But let's be real here. Any proper e-commerce platform that has enough traffic is collecting data in some way, shape, or form. How different the qualities are, I don't know how differentiated they are, but they would also try to like glass themselves to Stitch Fix. Then you've got the fact that they've moved into the resale of used apparel, which already has two players on that corner, Poshmark and ThreadUp. Poshmark has a $1.8 billion market cap. ThreadUp has a $1.8 billion market cap, so slightly north of the estimated range for Rent the Runway at the present. Poshmark does $300 million in revenue on an annual basis. ThreadUp does $200 million, although they all are both also losing money. Stitch Fix is the only profitable one in that cohort of new age apparel companies. So they're able to do more revenue, and they have explicitly the business muscle built of reselling this apparel. Rent the Runway is moving into that as a tangential business.
Yeah, they didn't start out as that.
So really where I land here, and I'm kind of giving away the bull in the bear case, but please stick around because I will make more points to that end. I move this more in the category of MoviePass or WeWork. MoviePass was a unsustainable subscription business. The only way that they could get people to pay the monthly subscription for movies was by giving them access to an infinite amount of movie theater trips with that subscription. They eventually ran out of money and went out of business. I'm not saying necessarily that Rent the Runway will run out of money and run out of business, but they are not trending in a healthy direction, and they share more qualities with that than they do of a Duolingo or a Stitch Fix. WeWork, in a similar case, and I'm only going to tease it here, has some adjusted EBITDA shenanigans that they took on when they attempted to do their IPO, which could have valued the company at $47 billion and would have been a travesty if that had been seen through. Public markets did not bite at anything remotely close to that number. I am slightly skeptical of Rent the Runway's capacity, even at this lower number, to meet that mark, but we will get into that in more detail in the bull and the bear case.
Awesome. Well, now it's time for the meme factor. If you're unfamiliar with the meme factor here on the rundown, it is where Aaron and I rank the memeability of a company on a scale from 1 to 5. 1 is negative memes, 3 is completely neutral, you feel nothing when you think of this company, and 5 is all the positive, ultimate dank memes. I think my meme factor for Rent the Runway is... It's certainly not neutral. Like it's either skewing really low or really high. And it really doesn't have the positive associations that Stitch Fix does, that some of these other like box subscription services do. I think I'm going 2.0.
Oh, wow.
Yeah.
I'm going 3.9, and I think it's for a company this size, they get an outsized amount of PR and coverage, partially as an echo of when they were really hot as a company 3 to 4 years ago, and partially because they are still such a novelty in the spectrum of business models. It's something that I think a lot of the other $1.4 billion market cap type of companies that we cover here do not have the degree of intrigue outside of like your kind of niche investor that a Rent the Runway does because of its kind of broader consumer consciousness.
Interesting. Wow. Before we move on to the bull and the bear case, please hit subscribe. We're trying to grow your business brain here on the rundown. We don't want you to miss a single IPO video, and we have a lot coming up.
We do it all the time. Allbirds, all sorts of good ones coming.
Life insurance company that you're much more excited about than
India.
I am. There you go.
That's why I stole Allbirds.
All right, on to the bull and the bear case.
The bull case is relatively straightforward. This is a company that survived COVID. It took its lumps, very much like an Airbnb. That's another analogy that you could draw if you're trying to position this in a certain way. It took its lumps. You could imagine it will never face a more difficult stretch than that because of how dependent they are on people interacting in the real world for them to garner the revenue that they aspire to and that they need to survive. So the very fact that they survived that, and it was an opportunity where they had to cut half of their workforce, half of their total expenses as a company. They cut that down, they got lean, they got focused, they got refocused and clarified their business by also adding the resale element. And the core building blocks are there for a future where people are focused on sustainability, on the circular economy, on these very large thematics that they can tap into. And as people tend to make those types of choices, maybe they're not buying luxury, maybe they're just renting it, maybe they're just reselling it. And if that resale market is big enough to have a shared pie between all those players, they are going to be players in that space given their volume.
Pretty strong bull case.
On the bear side, I'm going to come back to the point of adjusted EBITDA. EBITDA, earnings before interest, tax, depreciation, and amortization, is a metric by which many businesses are evaluated by investors because it gives you an insight before those elements. Is this company running profitably or not profitably? I come back to WeWork, which had a comically large adjusted EBITDA differential from the actual net income of the business. We look at net income because what that actually says is revenue minus expenses equals. It's a very simple calculus, very simple formula. Your adjusted EBITDA is slightly amended because maybe there are considerations that if you give me a little bit of time to talk about, hey, we made this investment into launching our software platform in this market specifically, but this expense will literally never happen again. It's a one-time startup cost. And now that it has been spent, you can actually see our business through the lens of this adjusted formula. It is why some people would justify using adjusted EBITDA as a method. But when it is used to an extreme, and in this case, Rent the Runway is depreciating their assets the way you would depreciate a car, a house, these very hard, big, long-standing assets, that equipment that very kind of large industrial companies use to assuage for the fact that there is a depreciation of their goods. When they're using that to depreciate apparel and clothing for a significant amount of adjusted EBITDA, and then after their adjusted EBITDA statement is completed, they only get down to a loss of $18 million in 2019 and a loss of $20 million in 2020. So even after, you know the accounting there is massage.com, right? They're pushing every single thing that they possibly can, including the apparel that you're buying, which I would argue is a cost of goods sold. That is the cost of doing business, not some sort of depreciation thing that's pushed over there. When you have all those shenanigans happening and it is still not profitable, it begs the question, can this be profitable in its current form? It begs the question, is this a business, was this a business that was a kind of more niche novelty than was originally realized? Because there used to be Plato's Closet and these other businesses that were all about, reselling. That's not a new business model necessarily, digital platform, blah, blah, blah. Is it just not something that can ever be that big? Because the actual demand for this is not that large.
That's a great question. We hit you with the hard-hitting questions here on the Piper Rundown. We appreciate your viewership. We'd like to shout out one of our commenters from a recent video. Oh man, this was on our Vita Coco IPO, which just went up. Yeah, I don't know the slip of the tongue there. Vita Coco IPO, which just went up recently and is already getting some traction. Guardian Offshore said, by far the most in-depth video on Vita Coco yet. Just put in for 200 shares at IPO. Damn, son! Damn! It's very exciting stuff. We'd love to hear what moves you're making based off of this information. Disclaimer, we're We're just two goons on YouTube trying to grow your business brain. We never advise, hardly ever advise, on actual financial advice.
But we do like making you smarter. We do love all the comments and your perspective being added. We've made mistakes too. People call us out in the comments. We are not pretending to be perfect in any way, shape, or form, but we are committed to doing the hard work so you can build a better business brain.
Absolutely. Thanks for watching.